Alright traders, pattern of the day is a triangle that leads to a very tight moment that leads to a major move. If you want to be prepared for that major move, let's teach you everything you need to know about triangles today. All I ask is you subscribe and like the video because we're putting out education on this second channel and it's an exciting lesson today. As you can see, Tattooed Chef is forming a triangle. This is on the daily chart and this has been consolidating for one whole year in a triangle pattern. And all this means is that the buyers and sellers are evenly matched and there's no long-term direction up or down. They're just trying to figure out where this company should be valued. So it's an even match, and once we are over with the match, every single stock market, day is either an inside day or a ranging day. And this is a year of ranging. So the longer the battle, the bigger the breakout once the winner is decided. So we're looking here to see where Tattooed Chef is going to go up or down. I don't have a bias, and you do have a bias if the triangle is flat on the top or flat on the bottom. If the triangle has slopes on the top and the bottom, this is an even triangle. Even triangles have no winner and no loser right now. It's totally even for buyers and sellers. So right now we don't have a direction where we think it's going to break out. We're just going to react when it does. But until then, when you're playing the range within the triangle, that's where all the money is made. And the earlier you spot the triangle, the better. So let's take these off and let's show you exactly what I'm talking about. So we did have Tattooed Chef make a high up here, an ultimate high and an ultimate low down here. And for you to plot the triangle, all you need is the next high and the next low. We don't really get that until right about here. This is the real one that holds. We had a fake one here, a fake one here, but the real important ones are over here and over here. So we see those ones come in. And I just want to show you the difference of drawing these lines connected. So this one here, as you can see, is just a very aggressive triangle, and this one here is a very aggressive triangle. This isn't really the triangle we drew initially. So if you saw that, it didn't help you at all. What we're really looking for is this line down here to be drawn, and all you're looking to do is put them at the candle bodies or the candle wick. It's up to you. It's up to your preference. I personally do the bodies because I see the bodies holding. Wicks they don't really matter in the market because wicks aren't closed. If the market closes at a certain level, it means the buyers and sellers decided, hey, this level matters to me. But if the price level went from 50 to 100 and back down to 50, there's not too many buyers and sellers at 50. So we know they didn't really truly battle that level out and close it and care about it. So that's why I do the bodies. If I do that body and I connect it to the next body here, you do see in the future it predicts the next two lows. It's not perfect. I'll zoom in. You can see there's candles closing beneath the line and it's just not to the T. So that's why we adjust as the future comes. But I'm going to show you if we connected this one over here to even this one, the first one here, if we do the bodies, you're going to see it predicts every single high until we get over here, then we get a bunch of false breakouts. So every time we draw a pattern, a support or resistance line, what you're going to see in the market is moments where it goes above and you think it's going to break out, go to the moon, and it fails. We see that all the time in long-term patterns. It takes a lot to break a long-term pattern. So we don't see this one truly break, but we see a bunch of attempts to do it. And these attempts are going to stop you out. It's so much better in the market to play the range and play the move back to the next level than to play the breakout. If you're expecting breakouts and you're getting bullish when it's getting above here, you're more likely to get stopped out. The chance of it going down and staying underneath this level is so much higher in every single setup. So you can see all these points I plotted are false breakouts. Those are moments for you to lose money. If you were smart, what you do is you wait. You got to wait for it to close a couple candles above the line for a move and validation higher, or below the line for a move and validation lower. So what we're looking for here, honestly, the best thing to play is a lot of candle consolidation at the support or resistance line. And I'm going to zoom in and show you exactly what I'm talking about. So the more we consolidate at these levels, the more we validate that we're going to reverse off of them and not go through them. So if I scroll into this section here, you can see there's a lot of chopping right at the bottom. And if I show you exactly this moment, you can see there was many tight candles. And the reason we know it's going to reverse is because the candles have wicks on the bottom. And the bottom just means the buyers keep popping that stop back up. They're interested, they're accumulating there. So a lot of wicks, and we're also seeing a lot of tight candle bodies. If we go to the past over here, these candles are large. These are about $3 candlesticks. There's $3, there's $3. When we get to the bottom, these candles are about 20 cents if we're looking at the body, and this one right here is about 30 cents. So the candle bodies got extremely tight when we finally hit support. This means that the sellers were originally in control. Big candles dropping it down. We knew they were in control. But now the buyers start reversing this. They start coming into control. And that's where we see the candlesticks get smaller. And we see the wicks really penetrate on the bottoms here. So this is your moment to play that massive move to the top. And this is why it's so important to spot these lines early so you can play that massive move, because the longer it takes for you to spot the triangle, the less opportunity and less money you can make. You can see here the range from top to bottom was 80%, about $11. And if we go from top to bottom over here, it's $9. And if we do the next move from bottom to top, it's $6. So half of the original move if you spotted this super late. And now we're seeing top to bottom about $5. And we're getting to the point where we're going to see the breakout from this line when we hit the apex. So the apex is our huge move potential zone. And we love to see the breakout from there. And the funny thing about this chart, it makes me laugh, is the apex is actually at earnings. So we usually see big moves on earnings regardless, but it's kind of funny how that lined up there. It's almost like algorithms are just programming this in and waiting for that move to happen there and just condensing the stock until it gets there. So Tattooed Chef, let's teach you how we would play this again. So all we're looking for is once we hit the range and once we recognize it, is we're looking to just play the move from support to resistance or resistance to support. And what we want to do is wait. We want to be patient, get longer term contracts when it hits it, and wait for at least 3 or 4 touches of this high level. So if we look over here, you can see we have 1 touch, 2, 3, 4. And you don't really break any key levels until over here. So you can see this key level is broke and it led to the breakdown. Some retests over here, but we didn't hit that final level. And it took about February to April. So 2 to 3 months. And you got to have more time on these contracts. It depends on the time frame you're looking at. So what I do is I go to the ATR. This is one trick I'll show you on how to pick the right option contract. The average true range tells us how much this sucker can move with the candlesticks we're seeing. Let's go to the weekly chart too. And as we look at the weekly chart, the ATR, if we were looking for puts up here, here's how far you should be looking to go out. You got the ATR at about $3. And the move lower, like we said, is about 9. So if you went 3 weeks out, that would be the minimum you would need to get this move to down here. And that would be a 50% drop in the stock, multiply that by 10 with options, 500% possible return. But you're usually wrong by a factor of like 7 to 10. So instead of 3 weeks, you want to be putting on 7 times 3, 21 weeks, or 10 times 3, 30 weeks. And 30 weeks is about 6 months, let's say, maybe even 8 months. So you're going to be putting on a lot more time on these. It takes 3 months to get down, and you still have 3 months on your contract. So that's your factor of safety. If you did 7 weeks, now you're looking at 3 months, the exact time of the move. So although the ATR is 3, it typically doesn't happen in 3 candles. That's the best possible scenario. If we look, if you take at the very best candle here, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 candles. So 4 times the move. So my 7 to 10 ratio would have been great for this. And if we look at the bottom, if you took it on this candle here, ATR is about 3 to 4. You should get a move in 3 to 4 candles. The uptrend happened in 3 weekly candles. If you took it at this candle, 3 weekly candles. Like I said, best case scenario is the ATR moves exactly the number it says it's going to every single week until you hit resistance. And that's what happened at this moment here. But what we see with the triangle is the big aggressive moves happen in the beginning, then the moves get choppier and choppier and choppier as we get tighter on the triangle. And there's a reason for this. This is because as the triangle gets tighter and tighter and tighter, more price action happens inside of it, which means there's more resistance and support. There's more buyers and sellers that bought in a previous region that are going to buy and sell again. So it's going to take longer. It's going to be harder to get through these regions. And that's what we see after February. These candles, the ATR drops dramatically. You did see the ATR go from 4 down to about 2.3. That's again because the buyers and sellers are making their bids and asks and creating history and structure through this chart. But what you want to do, like I said, is just peg the top for puts, peg the bottom for calls, and don't predict the breakouts. It's not going to happen as much as you think it's going to. When you see these moves, these false breakouts, don't get looped into them. They're more likely to come back inside major patterns and major support and resistance lines. But again, this company, it's an early company. The valuation is a little stretched at this point. So the fact that this consolidates makes sense. But if this was a growth stock that was valued correctly, we could see the breakout more earlier. And we could see the breakout happen and run. But if this stock is super overvalued, check out what happened in VLDR. And I'll show you this chart here. So this one, if we draw the triangle from here to here, this stock just was not valued correctly. And you could see the breakdown happened, and it was much more likely just taking into account the stock valuation, price to sales, profitability, future potential, and everything. We do have something called a bull flag and a bear flag, and those are leading to future moves with the trend. And those are triangles that are just structured a little bit differently, with a hard line of resistance or a hard line of support. And I'll try to show you one example of that. So here is Riot, and you can see triangle, support. You can even draw it here. And this is not really a bull flag because the line isn't at the top, but you can see that the downside was looking to break. If we look at the idea behind this, this is because we have lower highs, lower highs, lower highs. That's weakness. But when we have equal low, equal low, equal low, that's weakness. So this triangle is a weak triangle. If we flipped it, we had higher highs, equal highs up here. Let's see if I can draw this correctly. Something like that. That would be bullish because if we keep touching the exact same level, we're more likely to break it and continue. So 2 extra types of triangles we'll go through in a future video, but that's all I got. If you want to trade with me 7 days for free, hit the link below. If you want to see our playlist on charting and technical analysis, check it out in the video to the right of me. Peace out, traders. Have a great day.